Hey guys, welcome to the Bitcoin Fortress podcast, helping you increase your financial freedom. This is episode 165, recorded here on May 4th, 2025. May the 4th be with you. This podcast is for entertainment only and is not investing advice. Please do your own homework. We are at block height 895217, Moscow time 1046. Fees are at 1, 1, and 2. As always, we'll start with the market news update and outlook to see what the fiat world is up to, and then we'll get into the weekly top Bitcoin news. Check out this week's featured post on the Bitcoin Fortress Substack, and then a little look ahead, and then we'll wrap it up. So let's get into the news. Wall Street closed out a strong week on a historic note, with the benchmark S&P 500 index on Friday notching a 9-day win streak, its longest such run since November 2004. Sentiment was boosted by some solid quarterly earnings and positive rhetoric on tariffs and trade, including signs that U.S. and China relations were thawing. Market participants also received a host of economic data that reflected the impact of tariffs, most notably the first quarterly contraction in U.S. economic growth since the start of 2022. In terms of earnings, Magnificent Seven members, Microsoft, Meta Platforms, Apple, and Amazon were the biggest names to report. Microsoft and Facebook parent Meta delivered blowout quarterly numbers and issued guidance that quelled economic concerns. The companies also said they remained committed to heavy spending on artificial intelligence. On the other hand, analysts fretted over the potential impact of tariffs on Apple's gross margins, while Amazon's slightly conservative current quarter guidance disappointed. For the week, the S&P 500 advanced 2.9%, while the tech-heavy Nasdaq Composite climbed 3.4%. The blue chip Dow rose 3%. Looking ahead, Wall Street will be focused on the Federal Reserve next week, with the central bank's Monetary Policy Committee scheduled to announce its third interest rate decision of the year on Wednesday. According to the CME FedWatch tool, market participants are near certain that the federal funds rate will be kept on hold. Policymakers and Fed Chair Jerome Powell have said that they're happy to take no action while considering further economic data. Powell's post decision press conference will be closely watched for commentary on tariffs. Meanwhile, the first quarter earnings season will continue to chug along. Investors will receive quarterly results from major companies such as Ford, Walt Disney, AMD, and Palantir. The economic calendar will see readings on the U.S. services sector and the trade deficit. Moving on to Bitcoin news. First up is Hodler's Digest from Cointelegraph.com for the week April 27th through May 3rd. The U.S. Central Intelligence Agency is increasingly incorporating Bitcoin as a tool in its operations, and working with the cryptocurrency is a matter of national security, Michael Ellis, the agency's deputy director, told podcast host Anthony Pompliano. In an appearance on the Market Analyst and Investors The Pomp podcast show, Ellis told Pompliano that the intelligence agency works with law enforcement to track Bitcoin, and it is a point of data collection and counterintelligence operations. Ellis added, Bitcoin is here to stay. Cryptocurrency is here to stay. As you know, more and more institutions are adopting it, and I think that's a great trend, one that this administration has obviously been leaning forward into. U.S. crypto exchange Kraken has detailed a North Korean hacker's attempt to infiltrate the organization by applying for a job interview. What started as a routine hiring process for an engineering role quickly turned into an intelligence gathering operation, the company wrote in a May 1st blog post. Kraken said the applicants' red flags appeared early on in the process when they joined an interview under a name different from what they applied with, and occasionally switched between voices, apparently being guided through the interview. Rather than immediately rejecting the applicant, Kraken decided to advance them through its hiring process to gather information about the tactics used. The European Union is set to impose sweeping anti-money laundering rules that will ban privacy-preserving tokens and anonymous cryptocurrency accounts from 2027. Under the new anti-money laundering regulation, or AMLR, credit institutions, financial institutions, and crypto asset service providers will be prohibited from maintaining anonymous accounts or handling privacy-preserving cryptocurrencies such as Monero and Zcash. Article 79 of the AMLR establishes strict prohibitions on anonymous accounts. Credit institutions, financial institutions, and crypto asset service providers are prohibited from maintaining anonymous accounts, according to the AML handbook published by the European Crypto Initiative. So I guess they're not into privacy. Hmm. None of the governments really are. Ether, more like a meme coin, says trading firm as ETH drops 45% year to date. Don't care. Shouldn't be investing in that. Movement Labs confirmed the suspension of its co-founder Rushi Manche following controversies over a market maker deal that he brokered. Movement announced the suspension of Manche in a May 2nd X post explaining that the decision was made in light of ongoing events. The decision follows Coinbase's recent decision to suspend the Movement network trading, citing the token's failure to meet its listing standards. Listing standards. The suspension came after a recently announced third-party review requested by the Movement Network Foundation into an agreement orchestrated by Manche with Rentech. The latter helped broker an agreement with market maker Web3 Port. Private intelligence firm Groomlake is conducting the investigation. Shitcoinery, stay away from it. Let's see. We'll be covering this next, but or a little bit later. Bitcoin to a million, fueled by ETF and government demand, according to Bitwise exec. The U.S. Treasury Department is seeking to bar the Cambodia-based Hui One Group from accessing the American banking system, accusing the company of helping North Korea's state-sponsored Lazarus Group launder cryptocurrency. The Treasury's Financial Crimes Enforcement Network proposed on May 1st to prohibit U.S. financial institutions from opening or maintaining correspondent or payable through accounts for or on behalf of the Hui One Group. Hui One Group has established itself as the marketplace of choice for malicious cyber actors like the Lazarus Group, who have stolen billions of dollars from everyday Americans, U.S. Treasury Secretary Scott Bessent said in a May 1st statement. Senator Cynthia Lummis and at least one other Republican in Congress are reportedly critical of U.S. President Donald Trump for offering the top holders of his meme coin a dinner and White House tour. According to a May 2nd CNBC report, Lummis said that the idea that the U.S. president was offering exclusive access to himself in the White House for people willing to pay for it gives her pause. She wasn't the only member of the Republican Party to be critical of Trump's meme coin perks announced on April 23rd, roughly 3 months after the then president elect launched the Trump token. I don't think it would be appropriate for me to charge people to come into the Capitol and take a tour, said Republican Senator Lisa Murkowski, according to NBC News. Yes, Bitcoinery, very disappointing. The United Kingdom's financial regulator, the Financial Conduct Authority, plans to stop retail investors from borrowing money to fund their crypto investments. According to a May 2nd Financial Times report, the ban on borrowing to fund crypto purchases is one of the upcoming crypto rules by the FCA. David Giel, FCA Executive Director of Payments and Digital Finance, told the FT that crypto is an area of potential growth for the UK, but it has to be done right. He added, to do that, we have to provide an appropriate level of protection for your safety. Thank you. Thank you, government. And that wraps up the Hodler's Digest. Moving on, this from Decrypt. Public keys. Strategy doubles down on Bitcoin plans. Robinhood glitters with gold. Public keys is a weekly roundup from Decrypt that tracks the key publicly traded crypto companies. So let's jump into it. Bitcoin Treasury and software company Strategy, which trades on the NASDAQ under the MSTR ticker, unveiled its 4242 capital plan during its Thursday earnings call. The company famously pledged to raise $21 billion to acquire more Bitcoin. Now it wants to amass $42 billion in equity and fixed income by the end of 2027, according to CEO Phong Le. But even while the company literally doubled down on its bullish Bitcoin stance and raised its 2025 Bitcoin yield projection from 15% to 25%, it posted a decline of $16.49 per common share. That's in part due to the company pivoting from on-premises to subscription model with its software customers. Yeah, remember those? Strategy has customers who pay for its data analytics software, even though it's got nothing to do with Bitcoin. In Q1, total software revenues were approximately 111 million, down 3.6% year over year. Andrew Kang, chief financial officer, said during the call. The lower product license revenues, along with support revenues in Q1, continues to be as expected, and our overall revenue trend continues to reflect the ongoing transition of our software business from on-prem to the cloud. The company has now reported 5 straight quarters of losses after having seen a quarterly gain of 89.1 million in Q4 of 2023. But analysts don't care. The stock has climbed 3.35% to $394 as of close Friday, after getting a boost from the likes of independent veteran analyst Fred Krueger. Strategy will have a stronger balance sheet than Apple within 18 months, he wrote on X earlier today. Wow, that's something. As CBOE, one of the largest global exchange operators, notes record high earnings per share and revenue on Friday. It also noted that it's built a really nice ecosystem around crypto there for customers to engage in. First, the metrics. Tariffs have been hell for global markets, but they helped increase EPS by 21% to $2.37 and revenue by 16% to $565.2 million, the company said in its pre-market earnings report. The catalyst was fear and uncertainty around the impact trade wars could have on markets, according to David Howson, CBOE's global president. He said index option volumes set a record in Q4 2024 around the time of the November US election. That record has since been broken multiple times in April as trade tensions escalated, he said during the earnings call. In his next breath, Howson noted encouraging growth in the company's new Bitcoin products, most notably our new Bitcoin index options, tickers CBTX and MBTX. Those launched in December, and just last week, CBOE launched CBO FTSE Bitcoin Index Futures. Yes, it's a mouthful, which trades under the XBTF ticker. It's a Bitcoin futures contract based on the price of Bitcoin and meant to allow investors another way to hedge existing Bitcoin exposures, including holdings in spot Bitcoin, Bitcoin ETFs, or other derivatives. Trading platform Robinhood, which trades on NASDAQ under the Hood ticker, also reported Q1 earnings this week. Like CBOE, Hood put big numbers on the board. The company saw a 50% year over year increase in revenue, and crypto transaction revenue climbed 100% to $252 million when compared to the same period last year. But here's the catch, that crypto transaction revenue has fallen compared to last quarter when it was 358 million. CEO Vlad Tenev said during the call that that's to be expected and that the company is working to diversify its business so it can absorb the ebb and flow of crypto trading volume without much impact to its bottom line. We're diversifying the business outside of the crypto business, which will make us less reliant on crypto transaction volumes, he said on an earnings call Thursday. But also within crypto, there's going to be diversification over time. So crypto itself will diversify and be less reliant on transaction volumes in the future. He didn't say how exactly crypto offerings would change, though. Instead, all that glittered for Robinhood in Q1 was gold. When you look at the gold credit card, we doubled the gold card holders to 200,000 just in the past few weeks, and we love what we're seeing. Tenev said during yesterday's earnings call, and in the past year, Robinhood has nearly doubled gold subscribers to 3.2 million, he added. Robinhood Gold, no, not that kind, helped the company rake in $18 billion worth of net deposits in Q1. The Silicon Valley-based trading platform gilded the offering for its premium subscribers during a presentation on March 27th. The new perks include Taylor expert managed portfolios managed by former Wall Street traders used to serve institutional and high net worth investors, private jet travel, and same day delivery of cash direct to a customer's doorstep. In other news, high stakes crypto companies are really pushing for the SEC to clarify that crypto staking and associated services do not fall under the shadow of its regulations. If there were clarity, then the US spot Ethereum ETFs would get a boost and at least be able to pull level with their counterparts in other parts of the world. The Japanese Bitcoin treasury company, Metaplanet, is on its way to the States. The company will operate its new entity, Metaplanet Treasury Corp., with a goal to raise $250 million to further fuel its Bitcoin treasury strategy. Bitcoin miner Riot Platforms shared Q1 earnings on Thursday, disclosing mixed results. The firm's revenue beat expectations and was up 13% from the previous quarter, yet Riot swung to a $296.4 million loss, or 90 cents a share. Moving on. This article's from CoinDesk from May 3rd. Arizona governor calls crypto an untested investment and vetoes Bitcoin reserve bill, making all of the Bitcoiners angry. Arizona will not be investing in Bitcoin, at least not this year. Governor Katie Hobbs vetoed a bill on Friday that would have allowed the state to hold the digital asset as part of its official reserves. The legislation, known as Senate Bill 1025, proposed using seized funds to invest in Bitcoin and create a digital assets reserve managed by the state. After passing the state house in a narrow 31 to 25 vote, the bill reached Hobbs' desk where it was swiftly struck down. The Arizona state retirement system is one of the strongest in the nation because it makes sound and informed investments. Arizonans' retirement funds are not the place for the state to try untested investments like virtual currency, Hobbs wrote in a statement. The veto ends a push that could have made Arizona the first state to set up a cryptocurrency reserve, and it could have even outpaced the U.S. Treasury Department in doing so. So, have fun saying poor, I guess. Next article is from Cointelegraph. This was updated yesterday. Pro crypto Democrats pull support for stablecoin bill in last minute. A group of U.S. Senate Democrats known for supporting the crypto industry have said they would oppose a Republican-led stablecoin bill if it moves forward in its current form. The move threatens to stall legislation that could establish the first U.S. regulatory framework for stablecoins, according to a May 3rd report from Politico. Per the report, 9 Senate Democrats said in a joint statement that the bill still has numerous issues that must be addressed. They warned they would not support a procedural vote to advance the legislation unless changes are made. Among the signatories were Senators Ruben Gallego, Mark Warner, Lisa Blunt Rochester, and Andy Kim, all of whom had previously backed the bill when it passed through the Senate Banking Committee in March. The bill, introduced by Senator Bill Hagerty, was formerly known as the Guiding and Establishing National Innovation for U.S. Stablecoins, or GENIUS Act. The Senate is expected to begin floor consideration of the bill in the coming days, with the first vote potentially taking place next week. The bill has been championed by the crypto industry as a landmark step toward regulatory clarity. However, the Democrats' about face reflects growing unease within the party. Although revisions were made to the bill after its committee approval to address Democratic concerns, the lawmakers said the changes fell short. They called for stronger safeguards related to anti-money laundering, national security, foreign issuers, and accountability measures for non-compliant actors. The statement was also signed by Senators Raphael Warnock, Catherine Cortez Masto, Ben Ray Lujan, John Hickenlooper, and Adam Schiff. Senator Kirsten Gillibrand and Senator Angela uh, also Brooks were absent from the list, who co-sponsored the bill alongside Hagerty. Despite their objections, the Democratic senators emphasized their commitment to shaping responsible crypto regulation. They reportedly said they are eager to continue working with our colleagues to address these issues. On April 27th, Caitlin Long, founder and CEO of Custodia Bank, criticized the U.S. Federal Reserve for quietly maintaining a key anti-crypto policy that favors big bank-issued stablecoins despite relaxing crypto partnership rules for banks. Long explained that while the Fed recently rescinded four prior crypto guidelines, the January 27, 2023 statement was left intact in coordination with the Biden administration. The guidance, according to Long, blocks banks from engaging directly with crypto assets and prohibits them from issuing stablecoins on permissionless blockchains. However, Long noted that once a federal stablecoin bill becomes law, it could override the Fed's stance. Congress should hurry up, she urged. Well, we'll see how that one proceeds. Be interesting to watch, but sounds like they want the shitcoin to be highly surveilled. So that should be fun. Next up, Bitcoin.com news. BRICS accelerates currency shift with new trade tools and payment systems, continuing to challenge the dollar. Foreign ministers from the BRICS countries highlighted their commitment to shifting away from reliance on dominant global currencies during a meeting in Rio de Janeiro earlier this week. The official chair's statement from the meeting of BRICS foreign ministers emphasized expanding the use of local currencies in trade and financial transactions within the bloc and with partner countries. The meeting, hosted under Brazil's 2025 BRICS chairship, underscored the group's intention to enhance economic sovereignty and regional cooperation through new monetary tools. The statement details the ministers underscored the importance of the enhanced use of local currencies in trade and financial settlements between BRICS countries and their trade partners. They reference paragraph 66 of the Kazan Declaration, which directs finance ministers and central bank governors to continue examining the use of local currencies, payment instruments, and platforms. This includes assessing the feasibility of a BRICS cross-border payments initiative, BRICS Clear, and enhancing the bloc's reinsurance capacity with a mandate to report findings to BRICS leaders. These initiatives are viewed as essential to deepening financial integration among BRICS members and reducing vulnerabilities associated with external economic shocks. The group also reaffirmed its commitment to fostering an investment within its own ranks and across the global south. The statement notes they emphasize the importance of continuously expanding local currency financing and strengthening innovation and investment and financing tools, and acknowledging the initiative to create new investment platform to boost investment flows into BRICS countries and the Global South mechanisms. This strategy is aligned with broader goals of financial inclusivity, economic resilience, and a transition toward a multipolar economic system that better reflects the interests of emerging markets and developing countries. The focus on local currencies and financial platforms complements ongoing discussions around BRICS-led alternatives to existing global payment systems. Ministers are expected to deliver concrete proposals for BRICS leaders to review, building on the momentum created by prior declarations and new institutional frameworks designed to accelerate intra-bloc economic collaboration. Next up, from Bitcoin Magazine, this was posted May 1st, how Bitcoin mining can energize real estate. Real estate is an energy intensive industry. During construction, significant energy resources are required for operating heavy machinery and equipment, as well as producing materials like cement and steel. Once constructed, buildings continue to demand substantial energy for various functions. For instance, residential properties require consistent heating, cooling, and lighting, while commercial properties like hotels, malls, and stadiums have additional energy needs for climate control, complex lighting systems, high capacity HVAC systems, and require energy for powering amenities such as elevators, escalators, and restrooms. Agricultural facilities and stables often use energy intensive systems for irrigation and equipment operation. This persistent demand for energy typically results in high capital expenditures and operational costs, imposing a significant financial burden on both homeowners and tenants. In most jurisdictions, including the United States, landlords can pass energy costs on to renters, further escalating living expenses. The specifics can vary depending on local regulations and the type of lease agreements in place, i.e., gross versus triple net. In Germany, for instance, reliance on imported energy resources, especially natural gas, has become even more expensive due to geopolitical tensions. With domestic options like nuclear power largely phased out, developers and property managers face rising expenses that inevitably filter down to tenants, driving up the overall cost of housing. Bitcoin mining involves miners searching for a random number that meets specific criteria with a solution typically found every 10 minutes. Although most readers are familiar with this process, known as proof of work, it remains a fundamental mechanism underpinning Bitcoin's security and decentralization. This process not only rewards successful miners with Bitcoin, but also transforms electricity into both processing power and significant amounts of heat. The more computational power employed, the more secure the network becomes, making it increasingly difficult for any single entity to control or manipulate it. With an effective system in place, this excess heat can be captured and utilized for various purposes, allowing energy to be harnessed in two dimensions: computing power and heat. The word sustainable has been so misused that I almost prefer not to use it at all. Like other positively connoted terms, it has been abused, especially by institutions that seek to control its meaning. Nevertheless, the underlying concept is sound, and Bitcoin makes it possible. By incorporating Bitcoin mining into energy management strategies, property owners can repurpose the excess heat generated by Bitcoin mining to meet certain energy needs. This heat can support building heating systems, warm water, or directly heat spaces such as residential and commercial areas. New energy systems are being developed to integrate Bitcoin miners with specialized heating systems, allowing for efficient use of the heat to maintain comfortable temperatures and improve energy efficiency within a property. In regions with sunlight, such as agricultural areas or warm climates, combining Bitcoin mining with solar panels presents a significant opportunity. This integration can substantially boost the return on investment for solar systems by monetizing the excess energy through Bitcoin mining. For residential properties with rooftop solar installations, this also addresses grid capacity challenges that can prevent homeowners from selling surplus energy back to the grid. By utilizing Bitcoin mining, excess energy can be absorbed, converted into reusable heat, and even generate profit. In many regions, including colder climates like Germany, building regulations mandate the integration of certain energy sources such as solar panels. However, the installation costs of solar panels can be high, with energy generation often limited. Bitcoin mining offers a solution by monetizing the generated energy, thereby providing an additional revenue stream that can help offset the high installation costs of solar panels. This added income makes solar energy and renewable energy systems in general more economically viable and financially attractive. Overall, integrating Bitcoin mining into real estate can result in several economic benefits. Reduced energy costs by repurposing excess heat from mining operations for heating or other energy needs. Property owners can reduce their overall energy expenses, thereby lowering costs for tenants. Alternative revenue stream. Bitcoin mining offers a Bitcoin denominated income stream similar to rental income in real estate. It can provide an additional cash flow alongside traditional real estate income. This extra revenue can be reinvested into the property or used to offset operational costs. Increased property value. Reduced energy costs through Bitcoin mining may increase a building's value by lowering operational expenses and potentially creating additional cash flow. Overall, properties that reduce energy costs and integrate renewable energy sources become more appealing to buyers. While Bitcoin mining offers significant potential for the real estate industry, regulatory considerations must be carefully navigated. In some jurisdictions, integrating Bitcoin mining into property operations may face legal challenges. These concerns can vary based on local laws and regulations, which could impact how mining activities are implemented and managed within real estate developments. Therefore, it is crucial to navigate local laws and regulations carefully to assess the viability, ensure compliance, and maximize the benefits of integrating Bitcoin mining into property management. Real estate developers and investors who embrace Bitcoin mining can position themselves at the forefront of a new era in property management where Bitcoin plays a key role. With the emergence of Bitcoin, real estate may eventually revert to reflecting its utility value as Bitcoin proves to be a superior store of value that many may prefer over traditional property investments. In this new paradigm, Bitcoin mining could further transform our view of properties, prompting us to see them not only as financial assets, but also as purposeful physical spaces that require proper care and can generate sustainable profitability. Integrating Bitcoin mining into real estate operations can actively support existing business processes and demonstrates how mining could positively impact living environments. As mining technology continues to evolve and its benefits become clearer, the adoption of these practices in real estate is expected to grow. In addition, a particularly exciting potential side effect for Bitcoiners is that many small scale mining facilities can be integrated in a decentralized manner. This could contribute to a less centralized Bitcoin mining ecosystem compared to the current dominance of the large mining pools. As someone with a background in real estate development, I appreciate that Bitcoin is not just a concept or utopia. It is a protocol and computer network with tangible impacts on our physical world. The synergy between Bitcoin mining and real estate offers a promising opportunity to enhance the energy efficiency and profitability of properties. The integration of Bitcoin mining into existing property structures or new developments currently faces several challenges, including regulatory uncertainties and the lack of pre-manufactured solutions that can be easily incorporated into buildings on a large scale. These obstacles underscore how early we are in the development of this technology, but also present a significant opportunity for entrepreneurs to innovate and create practical solutions. Just as it took decades to build out the internet infrastructure, the integration of Bitcoin mining into physical structures like real estate will need time and effort. This will require careful planning, allocating dedicated space for mining operations, integrating them into existing heating system, and addressing energy management concerns. A dedicated and forward-thinking landlord or property manager can overcome these challenges and unlock the benefits of combining real estate with Bitcoin mining. Great article, and super excited about that, actually. Can't wait to go buy my Bitcoin water heater next. All right, bitcoinnews.com. This was posted on May 3rd. Article is entitled El Salvador continues buying Bitcoin despite IMF deal. What? El Salvador seems to be buying Bitcoin even more after signing a deal with the International Monetary Fund that seemed to require it to scale back. Despite a $1.4 billion loan agreement signed in late 2024 with the IMF, which included terms to limit El Salvador's involvement with Bitcoin, the government has not stopped its Bitcoin strategy. Instead, President Najib Bukele's administration is more committed than ever to Bitcoin. And there's a little graphic here from a post in X that shows their wallet, and it just keeps growing. They have 6,101.18 Bitcoin valued at $527.2 million. There's a commitment of President Bukele to keep accumulating assets, said Economy Minister Maria Luisa Hayem in multiple public statements, including during the Web Summit in Rio de Janeiro. Bitcoin is still an important project, she added. El Salvador made history in 2021 by becoming the first country in the world to adopt Bitcoin as legal tender. While this move was met with skepticism from international financial institutions, um, Bukele's administration has continued to make Bitcoin a central part of its national economic plan. Reports from blockchain analytics platforms and the country's own Bitcoin office confirm that El Salvador is following a one Bitcoin per day purchase plan. As of now, the country holds now it's updated to 6,165 Bitcoin, worth more than $600 million at current prices. So I guess you could say a Bitcoin a day keeps the IMF away. Marisa, Maria Luisa Hayam reiterated this plan, saying that Bitcoin accumulation is not just a government initiative, but also a private sector one. There is an asset accumulation that we're seeing from the government perspective and from the private sector perspective, she said. The IMF has acknowledged concerns about El Salvador's growing Bitcoin reserves. As part of the $1.4 billion loan package, the IMF included terms to limit the country's exposure to Bitcoin, including making its acceptance by merchants optional, restricting public sector Bitcoin involvements, and ending further Bitcoin accumulation using public funds. But the language of the agreement left room for interpretation. When asked recently how El Salvador could continue to accumulate Bitcoin despite the IMF's terms, Rodrigo Valdez, the IMF's Western Hemisphere director, said the restrictions apply only to the fiscal sector. For El Salvador, I can say that yes, they are complying with the non accumulation of Bitcoin by the overall fiscal sector, which is the performance criterion we have, Valdez said, and we are focused on structural reforms, transparency, and governance, not just Bitcoin. This complex legal wordplay allows El Salvador to keep building its Bitcoin reserves without technically breaking its deal with the IMF. Some say the country is walking a fine line, sticking to the letter of the agreement, if not the spirit. Critics say El Salvador is sneaking around the IMF, while supporters argue the government is just sticking to its original plan and using creative ways to stay within the rules. To simplify, the IMF restricts the use of fiscal sector funds, core government treasury, which means the government's actual budget. It means not spending money received through taxation or sovereign debt, printing money. Fiscal sector funds also include the money the government acquires from international loans, such as the one from the IMF. The program of El Salvador is not about Bitcoin, Valdez said. It's much more, much deeper in structural reforms, in governance, and transparency. There's a lot of progress there, and also fiscal, and authorities have been making a lot of progress implementing the reform. Bukele has been a vocal about his love for Bitcoin and often uses social media to show off the gains or mock the critics. According to recent data, the National Bitcoin Reserve has made a lot of money, over 100% at current prices. So keep going, El Salvador. Stack those sats. And finally, a little hopium to end the show before we get into the featured Bitcoin Fortress Substack post of the week. This article is from Crypto Potato, was updated on May 4th. Arthur Hayes sees Bitcoin at $1 million. Here's how it compares to Wall Street forecasts. Earlier in the week, ex-BitMEX CEO Arthur Hayes laid out his most audacious Bitcoin forecast yet, a staggering $1 million price tag by 2028. So just 3 years from now. He didn't back down when pressed days later in a follow-up interview with analyst Kyle Chasse, instead laying out a roadmap for how global financial chaos will make it inevitable. In a series of posts on X, Chasse unpacked Hayes' thought process, revealing the Maelstrom CIO's prediction envisions a radical scenario where Bitcoin is no longer just a speculative asset, but the ultimate hedge against a global financial system possibly teetering on collapse. According to Hayes, the world is splitting into economic blocks, with the US and China locked in a slow motion decoupling. If traditional systems falter, the crypto investor expects the ensuing treasury buybacks, bond market panic, and what he calls monetary detonation will nudge institutions to flee to Bitcoin. Bitcoin isn't risk on anymore, Chasse echoed. It's system off. In his post, the crypto influencer explained that Hayes' estimations will possibly play out in two phases: a surge to 250 by late 2025 as liquidity floods markets, followed by a moonshot to seven figures triggered by ballooning deficits, debasement, and unstoppable digital scarcity. While some may consider the BitMEX co-founder's view too ambitious, it's not entirely disconnected from where parts of the traditional financial world see Bitcoin heading. Several firms have recently upgraded their Bitcoin price targets amid strong demand for spot Bitcoin ETFs, reduced post-halving supply, and favorable macro setups. Fundstrat's Tom Lee and H.C. Wainwright both land near Hayes' interim target, forecasting 225,000 to 250,000 for 2025. BlackRock and Social Capital CEO Chamath Palihapitiya come closest to Hayes' $1 million prediction at $700,000 and $500,000 respectively. Meanwhile, Standard Chartered and Matrixport have lifted their year-end targets to 200,000, while VanEck sees the possibility of a cycle top that reaches as high as 250. While the projections fall short of the $1 million mark, they're finally recognizing Bitcoin's potential to move well beyond its previous all-time highs. And we will just stay humble and stack sats, and Bitcoin will do what it will do. Check out this week's featured post on the Bitcoin Fortress Substack, link included in the show notes. The Echoes of Empire, what 2025 can learn from the 1930s and 1970s. So that was a fun one. So check that out. And looking ahead at the future upcoming posts for the Bitcoin Fortress Substack, lots of cool and interesting things. First up, Bitcoin market cycles. That'll be coming up on Monday. Then we have Bitcoin mining and energy, followed by the best places in the world for Bitcoiners and sovereign individuals, 2025. The Byzantine Generals problem. Bye bye passwords, understanding passkeys 2FA and the future of secure logins. And a brief history of financial crises. So if you want to read all that, sign up. It's free. And if you really like it, you can be a paid supporter. And with that, I will thank you for listening to the podcast. If you enjoyed the show, please like and leave a comment. Also, don't forget to subscribe on your favorite podcast app so you don't miss an episode. You can also follow my Substack at bitcoinfortress.substack.com. And you can follow me on Nostr. My NPub is in the show notes. And with that, I will talk to y'all next week. Bye bye.